So on Friday, the stock market absolutely tanked. It plummeted. And it's hilarious the number that it plummeted because you can draw some funny conclusions if you're, religiously minded. It tanked 666 points. 666, bitch. That's how much it dropped. So, the question is this going to be the giant downturn that I've been warning you about for a while now? Well, the answer is maybe, maybe not. We'll have to wait and see. You don't pound the gavel yet. I mean, what I'm expecting is a downturn equal to or worse than the subprime mortgage crisis and the Great Recession. And I do think that's coming. I don't know exactly when it's coming. It could be now. It could be 3 years from now. I don't know. But it's certainly coming. I know there's going to be a crash. I just don't know exactly when it will be, and I don't know exactly which thing will be the catalyst because there's 1,000 problems in our economy, and our fundamentals are all fucked up. But the catalyst of this sharp drop, according to USA Today, if indeed they're right, is an indictment on our entire economic system. Now, you might say, that sounds like hyperbole, Kyle. Well, hold on. We're going to go directly to the passage I'm talking about here, and then you make up your mind. So USA Today reports the following. Ironically, Friday's sell-off was sparked by continued good news in the job market, with the government reporting that the economy created 200,000 jobs in January, and data showing wages for U.S. workers rose at their fastest pace since 2009. A pickup in pay that spurred fears of a spike in inflation. Good news for workers is viewed as not so good news for stocks, as it suggests the economy is in danger of overheating. That could pressure the Federal Reserve to hike short-term interest rates more aggressively than expected, says Russell Price, senior economist at Ameriprise Financial. So do you understand what they're arguing there? They're saying two things basically were the catalyst for this giant dip in stocks. One of them is the fears that the interest rate is going to go up. But as they explained, the slight uptick in wages made it so stocks plummeted. What? What? Hold on. So hold up. So this giant fucking thing that you have like libertarians and anarcho-capitalists treat as some sort of a god, right? The market, oh, all appease the great market, we love you so. That does poorly when wages go up. The market does poorly when wages go up. It's almost like what we've been saying from day one is 100% accurate, that the market is not an accurate reflection of the well-being of your average worker. That the market is not a reflection of the health of the middle class, the working class, regular people. That the market is a reflection of corporate profits and the mega rich. So when there was a slight uptick in wages for the first time in a long time, they go, oh my God, this is terrible. And then the market tanked. You think the system needs to be revamped a little bit, this system that we work under? I think so. And what's funny is that that's not even, like, they don't get that, the elite class, I should say. They don't get that actually in the long run, it's better for you if working people have money. Because we saw what happened with the Great Depression. So during the Great Depression, the top 1% made 24% of the income. Top 1% made 24% of the income. When that happened, basically, the working class was so poor that they didn't have the money anymore to buy the goods that the so-called captains of industry were producing. So then the economy ground to a halt. Now, on the flip side, when we had what was called the golden age of economic expansion, after FDR rolled out regulations and cracked down on Wall Street and did the New Deal, and we had an increase in unionization, during that time frame, the amount of income that the top 1% was making, it was between 8% and 12%. So the top 1% made 8 to 12% of the income. When that was the case, we had a stable system. We never had these bubbles. We had decades of no crashes because it was steady, slow and steady economic growth. But now, since we're back to deregulating and cutting taxes for the rich, screwing over workers, you have these giant spikes. You have what's called a boom-bust cycle in economic terms. So everything takes off. Oh my God, everything's so great. Look at this. Good times are never going to end. Oh shit, there's a crash. This is exactly what happened in the Roaring '20s. Oh my God, everything's so great. Things are never going to turn down. Oh no, it's the Great Depression. And then the subprime mortgage crisis and the Great Recession, similar thing. But what these guys don't understand is that if you actually have workers making a decent income, that actually helps in the long run the economy. You're just not going to get the spikes in the short term. You're going to get slow and steady economic growth. But our economy is so fucked up now that at the sign of a slight uptick in wages, they're like, oh, I'm a panic! And then everything crashes. And by the way, as I'm talking to you right now, the Dow dropped another 320 points just this morning. The market just opened. It dropped 320 points. Oh, no. So maybe it is. I mean, again, I don't know if this is going to be the giant crash that I've been warning you about. I just know that there is going to be a giant crash and that all the things I've been warning you about are 100% correct. And so here, let me show you. I tweeted this morning. I said, every sign is there. Explosive growth. So we're in a bubble. Over $1 trillion in student loan debt, over $1 trillion in credit card debt, stagnant wages. Again, stagnant wages is overall. So in other words, we had a slight uptick in wages, apparently, just recently. But the chart looks like this. Stagnant, 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 stagnant from the 1980s, and then there's a slight uptick. So it's not, don't get it twisted like, oh, but their wages are fantastic now. Half the country makes $30,000 a year or less. Half of workers in America make $30,000 a year or less. People are still struggling. But anyway, I continued. Multi-trillion-dollar unregulated derivatives market. Weak Wall Street regulations that were removed. Reinflation of the housing bubble. And then you could see the tweet of mine that I'm responding to. I said there, I honestly don't know if this is the big crash yet, but don't ever let anyone tell you that nobody saw this coming. And then you see the three headlines there. That one is from Friday. Dow dropped 666 points in sharp sell-off. And then the other one is from this morning. Developing. Dow drops 300 points, continues to drop, and is 300 points. And then the other one is my segment that I did 3 weeks ago, entitled, The Stock Market is Going to Tank. So, yeah. Look, I'm not a wizard. I'm not a genie. I just look at the facts and I go, oh, I see what's going to happen here because there's so much historical evidence to back it up. It's not like a hard prediction. But the thing is, people look at it like, oh my God, it's amazing that you were able to spot this. And the reason it seems amazing is because every single bobblehead idiot on TV doesn't know and doesn't say it. I mean, guys, again, I can't get over the CNBC example. Leading up to the subprime mortgage crisis and the Great Recession in 2008, there wasn't a single CNBC host who said, oh, the market's going to tank. Not a single one. All of them were like, the long-term forecast is tremendous. It's really great. I just want everybody to know that. It's very good. Every single one of them. The only exception was a guest who they let on, who's a libertarian economist. His name is Peter Schiff. He came on and he was like, no, I think there's going to be a crash and it's going to happen at some point in the near future. Of course, Peter Schiff was right. I would probably disagree with him on certain specifics as to why the crash happened, but nonetheless, he's right on the broader point. But he was the only person talking about hundreds of people who went on air on CNBC. Every single one of them were like, everything's great. Because what CNBC is, they're a corporate propaganda network. They let on CEOs of the giant corporations to do their propaganda. Whether it's the big pharma CEOs or Pepsi or whatever, all the different CEOs, let them on, do your propaganda, and then we'll act like you're the smartest guys in the room because you're wearing a suit and tie, so obviously you're a genius. And then when everything crashes, we act like shortest memory in history. Whenever something happens, we're just like, oh, let's not look at everybody who was dead wrong. Let's not look at the trends. Let's go right back to what we were doing before the crash. And that's what happened. So Obama implemented Dodd-Frank. Now, Dodd-Frank was a weak piece of Wall Street reform. He needed to do Glass-Steagall and a million other things. So it was weak, but at least it put some Band-Aids over the gaping, gangrenous wound that was our economy. some Band-Aids with a little bit of ointment on it. But then Trump gets in and he's like, yeah, we're going to get rid of all the Dodd-Frank regulations. We're going to deregulate even further. We're going to cut taxes for the rich, and we're going to cut taxes for corporations. And then those are the policies that drove us into the ditch in the first place. So it's not that hard to tell. There's going to be a crash. I don't know if this is the big one, but buckle up because at some point that big one is coming. Okay.